is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. China's manufacturing slump deepens in May, further denting the nation's recovery. Global stocks and commodities sell off. French inflation slows more than expected in May on lower energy and food costs. A boost for dovish voices at the ECB. The first German state to report also shows a drop. Plus, the U.S. House plan to vote today on the debt ceiling bill after clearing a key procedural hurdle. J.P. Morgan Chief Executive Dimon tells Bloomberg he's hopeful it will pass.
So I wish that one day we get rid of the whole debt ceiling thing, but I understand when, it's a democracy, people have different opinions about what we should be doing, and it's just one tool for one party to, get the other party to the table. So I'm quite optimistic there, and I really do applaud the fact that they all sat down and spoke, got something done.
Well, first things first, let's check on the markets. The ECB saying there are vulnerabilities in the financial system revealed by rate hikes. We're also getting quite a lot of data. So first of all, we have Italy final first quarter GDP rising 0.6%, a little bit better than the preliminary 0.5%. And then I hope you all studied geography, German geography at school, because we have CPI by the various states. So you have Hesse, Bavaria, Brandenburg. I don't know why I need I feel the need to actually pronounce it in a German accent, which I'm very bad at. But for the month of May, if you look at Hesse year on year, it's 5.9%. It does seem to be pretty much in line with expectations. Baden-Württemberg actually gaining 6.6%. So they're gaining, but they're not gaining as much as expected, or certainly there's a little bit of a slowdown, is what we heard also from French CPI, but also some of the Spanish CPI that we saw. So the difference in terms of the maps, when you look at the CAC 40 and elsewhere, for example, the FTSE down some 0.3%. The CAC 40 is down 0.6%. The focus firmly on Chinese data that disappointed in terms of PMI. So that gives us a little bit of pause for reflection, how much consumption they'll do of some, for example, of the sectors, including some of the metals, which is why we're seeing a bit of focus on oil, iron ore and copper. Those are down, and those are some of the biggest sectors that are losing. Now, China's manufacturing activity, as we were saying, contracted for a second straight month in May. It's more evidence that the post-COVID recovery has slowed in the world's second largest economy. Now, global stocks and commodities are lower, as well as the offshore yuan. So let's stay with China. And J.P. Morgan's chief executive says the bank will be in the country for both good and bad times. He remains committed to doing business there despite geopolitical tensions.
When we do business in the country, and we do business in 100 countries around the world, we are there for the citizens of the country. And we're there, hopefully, through good times and bad times. We tend not to leave other than there's war or civil war. And so we're not predicting any of that here. Obviously, it's become a far more complex situation. For some for good reason, some not for good reason. And, there's risk. There's always going to be risk. And I think you'll see companies react to different things for different reasons. Some is their own resiliency. Some is obviously national security, will trump all other things. So when, our government tells us to do A, B, and C, we're going to do A, B, and C and support it. And I think there's a risk in China itself that, if I've met with several people here. If you have more uncertainty, some of it caused by the Chinese government, well, of course, it's going to not just change foreign direct investment, which has gone up a little surprisingly, and I don't think they should assume that's going to continue, but it's going to change the people here, their own confidence, their own ability to invest and do things. China is obviously going to do what they think is good for itself, and business might be a positive attribute, but national security will trump all other issues.
Now, I was just at G7 where we heard a lot of that rhetoric where they're de-risking, not decoupling. But again, the Chinese say it's one and the same. It's America trying to limit China's rise. And you've seen that bifurcation. There's more jargon, not to overemphasize all this jargon that's going out there. But again, do you see de-risking being different from decoupling?
Totally. So if you ask me, over time, yeah, there'll be less trade. It'll take years for these things to take place, but it won't be a decoupling. And the world will go on. I think, like I said, I think far more important is what's happening in Ukraine right now. And so, hopefully this will sort out, and it'll never sort out if people don't talk. So I urge people, have some real deep conversation, get to know each other a little bit, each other's concerns about some of these issues, and things would be better if we had that.
Long time ago.
Me too. Well, that was Bloomberg's Stephen Engel speaking to J.P. Morgan's Chief Executive Officer, Jamie Dimon. I was distracted because I was speaking to Paul Donovan, Chief Economist at UBS Global Wealth Management. It wasn't high-level stuff. We were trying to remember how you pronounce a lot of the German cities, actually, because we both studied German. Comes in handy when you look at CPI from Germany, Paul.
Absolutely, yes, because it's coming out from all of the regions. But there's a fairly consistent picture, actually, that we've had with the Eurozone CPI numbers over the course of yesterday and today, which is it is coming down.
Yep.
And this whole idea of price stickiness, the inflation is going to be sticking around, is really being blown out of the water by these numbers. So the Spanish data, of course, came in very low. There's no stickiness there. And actually, interestingly, we're also getting this confirmed in the regional data in the United States. So, New York, Los Angeles have seen big declines in their CPI numbers. Doesn't appear to be very sticky to me.
Yeah, and you were one of the first ones, actually, I remember 4 or 5 months ago, coming on to say about some of the deflationary prices that we saw. And I think at the time you were mentioning, like, LED screens.
Yeah.
I mean, could it be that inflation will come down as fast as it came up? Or is that wishful thinking?
So I think that the issue that we've had is, of course, we've had 3 very different inflation episodes, just bang, 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 one after the other. The transitory inflation episode of durable goods, I mean, that's now in extreme disinflation or outright deflation, depending on which country you're in. The energy price supply shock, which has been the second wave, that's starting to slow down now. But the profit-led inflation is very culturally sensitive. So different countries have got different degrees of profit-led inflation. Yeah. Quite hard to see, say, in Switzerland, but a lot more common here in the United Kingdom. That speed of that decline will vary from country to country.
But so overall, are we in a much better place for the world economy? I was looking back actually at some of the forecasts that we had for the UK economy, and this is like the vanishing recession. We're not even expecting a recession anymore. Yeah. So will we be able worldwide to get away with a kind of mild slowdown? So
I think we do get a mild slowdown now. The negative forecasts that you're talking about were tending to come from the IMF, the OECD. They tend to be quite a long way behind the curve. So the market's long since discounted this sort of stuff. So it's not necessarily going to shift market expectations. But yes, we're getting, I think, a definite slowdown. But I have reasonable hopes that we will stabilise real incomes for consumers by bringing down inflation. And remember, we've just had 2 catastrophically bad years for real wage growth in every major economy. Now, if we can stabilise that relatively quickly by bringing down the inflation rate, that's going to stabilise consumer demand. We get a slowdown, absolutely, but it's not sort of the extreme negative scenarios that some people are worried about.
What do you do with China right now? So we had those PMI figures that is really, dragging a lot of markets lower, and concerns about how much copper and iron ore they'll consume.
So I'm always inclined to take survey-based evidence with a big bucket of salt. Survey-based evidence is very problematic. You get partisanship, you get the media cycle influencing it, and so on and so forth. What I think we can say, looking actually at the Chinese data, but also at the Japanese data that came out today, is that there is very clearly this ongoing shift amongst global consumers in favour of spending on services rather than spending on goods. The fanatical desire to go on holiday seems to be still in place. Yeah.
And here to stay?
And I think probably here to stay. I think there has been a shift. This was one of the psychological breaks coming from the pandemic. If you bought a new washing machine in 2021, you're not buying a new washing machine in 2023. If you're working from home, your company is scaling back the amount of office equipment that it's buying. So all of these things are leading to a rebalancing in favour of services and away from goods. And, of course, for a goods-producing country like China, that's bound to show up in weaker manufacturing data, and also sentiment, though whether the sentiment actually reflects the underlying activity is a more moot point. We saw that also with the Japanese industrial production data, and within the detail, it is more the export side that we're getting this moderation coming through.
All right, Paul, thank you so much. Paul Donovan, Chief Economist at UBS Global Wealth Management, stays with us, and we'll talk about the U.S. debt ceiling. The deal does seem to be moving forward with a crucial House vote expected later today, so we'll look at how the markets are reacting next. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the debt limit deal struck by President Joe Biden and Speaker Kevin McCarthy heading towards a vote in the House. That's after it cleared a crucial procedural hurdle with just days remaining to avoid a default. Well, we're now joined by UBS Global Chief Economist Paul Donovan, rejoined. So thank you so much, Paul, for sticking around. Is it, I wouldn't call it plain sailing, no, but is it now a done deal?
I think so. I mean, you've got to believe that
that's somewhere, a very wary, I think
somewhere in Congress there is a tiny iota of common sense. I am weary. It's like reliving the Brexit trauma all over again. This thing just never goes away. But I think, yes, we're going to get lots of shrill voices from political extremists, but I think basically the moderates will get this through.
So what are you looking at for in the next couple of days? Is it, you know, if Kevin McCarthy keeps his job, is it kind of big moves in T-bills in case there's another hurdle, or how they will deal with the debt longer term, which is a whole other issue?
So I think the market will just not pay any attention to the longer-term debt issues because the market doesn't tend to think that far in advance. I suspect that what we're going to see is a little bit of angst around the vote and probably a little bit of a relief rally. But the market, as I said, I think the market essentially adjusted with the weekend agreement. Does McCarthy keep his job or not? I don't think the market cares that much, other than if we're embroiled in yet more infighting in the House Republican Party, then that just delays anything else happening, and any other legislation, you know, you just push even further. We've just wasted the last 2 months, you know, with this whole farce, and now potentially there's another issue that comes up. So that would be a little bit problematic for some aspects.
Paul, you're a very good long-term thinker, and so I don't know whether we spoke to Jamie Dimon, who says, look, he's not really seeing any decoupling from the U.S. and China, although things are much more complex. Does something like the debt ceiling, you know, go to the heart of the issue of what happens to dollar as a reserve currency, even if it takes 10, 15 years?
I don't think so, because at the moment there still is no alternative. We've got to remember that the point of a reserve currency is it's where you want to keep your savings as a country or as an international organisation. And so you need liquidity, you need rule of law, you need political stability, you need absence of exchange controls. You also need, you know, large liquid markets. There really is not a viable alternative to this. And actually, we're seeing this. You sometimes hear central banks saying, well, we're going to start doing trade in this currency. But then they follow it up with, because we want to keep our reserves in dollars. So the dollar has still got that primacy as a reserve currency for now. And I don't see that changing in the next decade or so.
Paul, I mean, we're also about to, I mean, June is tomorrow, and that's Pride Month, and I know you do a lot of work at the crosshairs of, you know, economics and diversity and inequality, putting actually numbers onto this. Are we doing much worse in terms of LGBTQ?
We're doing better and worse. So there is, if we look in the States, this year alone, there's been almost 500 pieces of anti-LGBTQ plus legislation in state legislatures, which is absolutely horrendous. On the other hand, there's a strong fight back, and some, in fact, quite a number of these pieces of legislation have been overturned. I think that companies are increasingly recognising that they want people to come to work and be the best person they can, the best employee they can. You want the right person in the right job at the right time, and that means a diverse and inclusive workforce. And I think this is part of the broader issue of impact economics. Economics is evolving. People now don't just want the latest smartphone, though they do want the latest smartphone. They also want, you know, a sustainable planet, and they want diversity and inclusion. They want equality. They want themselves and their family members to be treated with respect. So all of that is coming together as a gradual evolution of where economics is going. So I think that there are reasons to be positive, but it doesn't mean that I think the LGBTQ plus community can give up the struggle, because struggle they must.
I mean, do you look at it from like region by region? I know you do also a lot of, you know, work on labor, labor dynamics and female participation.
Yes, so here we are seeing some improvements post-pandemic, because of course in the pandemic, female participation in the workforce fell. Disproportionately, women were responsible for looking after children's education. They were perhaps in part-time employment where, you know, the jobs weren't being kept during the pandemic. Now what's happening, as we move more and more to flexible working, the whole issue of childcare becomes more flexible. So whoever is the principal child caregiver, whichever gender, now has more options available to them, because you can work close to the school at a job you're really good at. You're just doing it from home. You don't have the long commutes anymore. That sort of thing is actually really helping, and we are now starting to see female participation above 2019 levels, which is, you know, obviously to be very much welcomed.
Paul, what does this mean for, I guess, economic prosperity? Again, we have a very tight labor market, so the more people come back into work, presumably it takes the edge off for a lot of central bankers.
It takes the edge off some of the numbers. I mean, I would dispute whether we can describe labour markets as tight when we've just had so bad a period of real wage growth. So on some aspects it's tight, on other aspects it's not. But I think what you end up with is a more productive, a more efficient workforce because you're putting the right person in place without paying any attention to irrelevant details like gender or sexuality or race and so on.
Paul Donovan, just brilliant on a lot of these key issues that we're trying to put the spotlight on. UBS Global Chief Economist there, Paul Donovan. Now, coming up, top officials from the EU and the US are meeting for a second day in Sweden for the Trade and Technology Council. We'll bring you what to look out for next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, top officials from the EU and the US are meeting in Sweden today for the Trade and Technology Council. They look to strengthen their cooperation on key issues from China to economic security. Now, let's get more from our Europe correspondent, Maria Tadeo in Brussels. Maria, so good morning. What's top of the agenda today?
Yes, and it's a busy agenda, Francine, because remember, this is a bilateral platform that was created between the United States and the European Union to deal with some of the pressing issues and trade, technology, of course, and the cooperation between the two sides. But today, one of the big focus, if I may say, will be China. For many diplomats, as you know, Francine, this is the defining question almost of the century, and just managing this relationship is the key question. Now, we've talked about a lot of de-risking, decoupling. What is the right balance? Yesterday, the U.S. Secretary of State, who is leading the American delegation, said they have a clear line and want to stick with it, and that is focus on de-risk, but do it seriously. Let's take a look.
The United States and Europe, I think, believe that, again, this relationship is an important one, one that we seek to sustain, but with our eyes wide open. And so both the United States and Europe are not in favor of decoupling, but we are in favor of de-risking. And you've heard that from the leadership on both sides of the Atlantic.
So no decouple, but yes to de-risking. Again, the problem is that is a term that everyone is using. You played that interview too with Jamie Dimon. Everyone is buzzing around this word, but when it comes to the actual substance, there's a lot of different opinions in terms of what de-risking means. And you see that play out in this meeting. Some Europeans believe that in a format like the TTC, you should not be calling out China aggressively. It's not the time, it's not the place. The United States wanted something similar to the G7 language, which again mentioned China 20 times and floated issues like economic coercion. It'll be interesting to see today whether there's any references to potential restrictions when it comes to outbound investment and trade from European and American companies going into China. That is seen as the next frontier. But again, this is a very lively debate. What de-risking means in details, that is still up for play.
Yeah, and it is indeed a very lively debate. Maria, thank you so much. Maria Tadeo there with the very latest from Brussels. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Elon Musk has told China's foreign minister in Beijing that the interests of China and the US are intertwined, echoing recent remarks from the bosses of Apple and Mercedes-Benz. The Tesla chief met Chen Gang on his first post-COVID visit to China. Musk is expected to tour Tesla's Shanghai factory later today. Now, North Korea has confirmed that an effort to launch a military spy satellite into orbit failed earlier today. The official news agency reported a rocket crashed into the Yellow Sea after losing steam in the second stage of the ascent. The launch initially prompted missile alerts in both Japan and South Korea. Pyongyang says it will attempt another launch soon. And Theranos founder Elizabeth Holmes has reported to prison to start her 11-year sentence for defrauding investors over the company's unreliable blood testing technology. A federal court convicted Holmes of wire fraud and conspiracy last year, with a final appeal failing last month. The 39-year-old is being held in a minimum security prison near Houston. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Leanne, thank you so much. And let's also have a look at NVIDIA that really had forecasts that blew everything out of the water. Yesterday it was gaining and became a $1 trillion company. Today, a little bit maybe of profit taking, but really it's not much given the general market context, down 1% in pre-market. Coming up, we'll be joined by Morris Reed, partner at global consulting firm Actim. We'll get his views on the debt ceiling and what's happening in the global economy. That's coming up next, and this is Bloomberg. China's manufacturing slump deepens in May, further denting the nation's recovery while global stocks and commodities sell off. French inflation slows more than expected in May on lower energy and food costs, a boost for dovish voices at the ECB. The first German state to report also shows a drop. Plus, the U.S. House plans to vote today on the debt ceiling bill after clearing a key procedural hurdle. JP Morgan chief executive Jamie Dimon tells Bloomberg he's hopeful it will pass. Be news if he didn't. Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, JP Morgan chief executive Jamie Dimon says he's optimistic that a debt ceiling bill will make it through Congress before the U.S. defaults. Well, he spoke exclusively to Stephen Engel a short time ago.
You know, America, the financial system of America, and the economy of America, it's still the most prosperous and largest economy the world's ever seen, the most innovative, the most growing, and the rest of the world relies on it. You know, so I think we shouldn't create any instability there. So I wish one day we'd get rid of the whole debt ceiling thing, but I understand when, you know, it's a democracy, people have different opinions about what we should be doing, and it's just one tool for one party to, you know, get the other party to the table. So I'm quite optimistic there, and I really do applaud the fact that they all sat down and spoke, got something done.
What's your read on inflation, on whether the Fed will go beyond the pause and hike again?
You know, my simple view is that, you know, they're right to pause at this point. It's been a big increase, you know, 500 basis points or so. Take a pause. But I do think it's possible they're going to have to raise a little bit more. That, you know, inflation is kind of stickier. I think people are coming around to that, which means rates may have to go up a little more. People should be a little prepared for that. You know, just as a matter of managing your own business, be a little prepared for that. Whether you're a financial company or a real estate company, et cetera. I think the other thing I'd be a little prepared for is the volatility that might very well be created by quantitative tightening. We've never really had quantitative easing, which we've had now for, you know, the better part of 15 years. And now you're going to see quantitative tightening. And I think the effects may be a little harsher than people expect. But hopefully we'll get through all of that and I'll be okay.
Well, that was JP Morgan Chief Executive Officer Jamie Dimon speaking exclusively to Bloomberg's Stephen Engel in Shanghai. Now, the U.S., it seems, is heading towards a deal to raise the debt ceiling, with Congress weighing up a bill ahead of the vote. Now, while progress is being made, cracks continue to appear in the U.S. economy, with consumer confidence falling to a 6-month low. Well, we're now joined by Morris Reed, partner at global consulting firm Actim. In a previous life, was also in U.S. politics, so he knows the inner workings of Washington. Morris, thank you so much for joining us. Debt ceiling, are we going to get something in the nick of time? Is there any chance that we don't get a deal?
We'll get it, absolutely, because we have to have it. The entire world is dependent on it. And it would be too much pain and suffering, not just for the consumers, but the political class would suffer immensely. So we'll get it done. It'll probably get done Saturday night, Sunday, vote on Monday, but it'll be done by Tuesday.
So who's it a big win for?
It's Kevin McCarthy. He is, in my opinion, he stood shoulder to shoulder with the president and didn't blink. People are surprised that the way he came into office, the fact that he would be able to push this through his caucus, which the White House completely underestimated, which is why they waited so long. So I think that Kevin McCarthy, as you remember, it started at the Big Four, the Big Two, and then it was mano a mano, Speaker and the President. And I think he did a great job, and he stood shoulder to shoulder and didn't blink.
But, Morris, at the same time, we're seeing lawmakers from the Republican side calling for him to resign. And I think he was asked about it yesterday, and he said a simple, nope, that's not going to happen.
Right.
Is he going to get internal pressure from having, so-called caved in?
No, I think what you'll see is the fringe elements, right? Yeah. Both on the Republican side, the crazy right, as we call it, and then the Democratic side, the progressive or the crazy left. Both of them are unhappy, which is always a good sign when both are unhappy. But he has a solid block, and frankly, the Democrats need this to push through. Quietly, and now starting to be louder heard, is Democrats upset the way the White House has handled this because they feel they've pushed them in a corner where they don't have much wiggle room.
Well, we've spoken to a lot of money managers, like, big private equity, also Science, saying they're always a little bit worried, especially the ones that are not based in the U.S. They're always worried in a U.S. election cycle because you don't exactly know where it ends up with. Is there going to be much more China bashing from both sides?
Absolutely. We're going to see much more China bashing through the election. Also, frankly, the Ukraine situation will go through the election, but that's because what Vladimir Putin people want. But there will be a lot of bashing. With the debt ceiling, this will very quickly move into the presidential election, right? Because Donald Trump will jump on this, and that process will move very quickly. Usually it waits until September. It'll move very quickly on Memorial Day now.
But more, if we have a debt ceiling agreement, and this is like, locked and loaded, signed before it becomes ugly, are we going to see both sides coming closer on key issues, or no?
Not at all. Not at all.
This is just a one-off.
This is a one-off, but it also gives the Republican Party in the House the ability to be more aggressive. They push the president in a corner. You'll start to see them being much more aggressive on some of the border issues, much more aggressive on some of the Hunter Biden issues. They realize that they can block the president's legislative agenda, which is okay for the president because he'll pull back and start to run a Rose Garden strategy where he'll govern by executive order. So both sides see victory here and some room to wiggle.
But, governing by executive order, is that a bad thing as you get into the presidential election?
No, frankly, it's a good thing when you use the bully pulpit, because as the President of the United States, no one has a larger bully pulpit. So this will work in Biden's favor, particularly if he has a candidate like Donald Trump, who will be extremely focused on the media.
Who's going to be the Republican nomination?
Well, if you looked at DeSantis' disastrous start, he's not ready.
What happened?
I think he just got bad advice. I think that he's a 44-year-old successful governor. In America, as you know, you run to lose to run to win. So he could be setting up the bank shot. But to me, it looks very clear that Donald Trump will be the nominee on the Republican side.
I mean, this is, quite unusual given a lot of the lawsuits against him. I mean, could he actually run? Is there a chance, first of all, that he goes to prison? And
I don't think
can he run from prison?
I don't think there's a chance he goes to prison, but unfortunately, he could be in prison and still run for president of the United States. But I don't think he'll go to prison, but I do think he'll be the nominee.
If there's a Trump versus Biden presidential election, who wins?
I think it's probably lean Biden. There's so many significant people, voting blocs, particularly women, voting blocs against Donald Trump. I think it would be difficult. Anyone else against Biden, maybe it's a toss-up.
Yeah, why is there still such a stronghold from Trump, given everything that we've seen in the last 36 months?
Money matters. He has a strong base of support, and he can raise money at an unprecedented level. So when you can do those two things, you ultimately, in American politics, generally get to the front of the pack.
Morris, we also have Rishi Sunak actually going to Washington next week. He's looking for a U.S. trade deal. Will he get it?
Absolutely not. And they have mismanaged this from the very beginning. What they don't understand in the UK is that the world has changed. You don't go to Washington through the front door to get a trade deal. You look at where the trading partners are working. That means in the States, you build support from the ground up, and then you put pressure on the White House. This is a White House that's been reluctant to do trade deals, and they won't do a trade deal, particularly in a political season, if there's no political backing, no political will. And that's what's lacking. I think he'll go there. There'll be a lot of happy talk, but he certainly won't get a trade deal.
But is this because it's the UK, or is this because also it's a prime minister that's quite weakened?
No, this has been from the beginning. The three prime ministers ago, they mishandled this because they were still thinking that you do it the old traditional way instead of understanding how you really affect change in Washington, which is outside the Beltway, galvanize support, put political pressure, and have the White House to do something for their constituents as opposed to foreign government.
So aside from China bashing, what does President Biden focus on?
Ukraine. I think that this is going to be an overwhelming focus for him. making
What,
sure...
more money, more weapons?
Yeah, more money, making sure that he's managing his caucus on the Hill, making sure that the Republicans continue to be... Some people are outliers, but most people understand the importance of Ukraine. He's also going to be looking at how this impacts Europe, because if you look at what, as you and I talked in the past, next year is U.S., U.K., and EU. I think we're going to have major change in the U.K. I think you're going to look at the EU. They're going to be really consumed by Ukraine because of the inflation, but they also have to worry about being the in between these big, China and America and how they play that just opposed to the relationship long term. So Biden's got a lot of things to worry about, but ultimately I think he has a clear path to victory if he's able to rally key constituencies and not fumble the ball.
But Morris, what about the economy? So if the Fed has to crush the economy to get to the inflation target, does that scupper Biden's re-election chances?
I don't think it does, but it certainly is going to make it more difficult. No president wants to have inflation going into a re-election. But it has to be realistic about it. And we can't, in America, we don't manage the Fed. The Fed does his own thing. But the president needs to get ahead of this, and he needs to make sure. A perfect example is the fact that he's got this $1 trillion infrastructure project, and none of the money has hit the street. So if he really wanted to have a way to fight this, he would push very hard to get money on the street, particularly in the next 18 months.
Yeah, and as long as jobs hold up.
If job holds up, but if you put $1 trillion to work, jobs will hold up.
Yeah, but then the inflation concern could be accentuated. Morris, thank you so much, as always. Morris Reed, their partner at global consulting firm Actum. Coming up, Britain, famous for its rain. Yes, it is. So why does the UK face a water crisis? We'll tell you why when we return. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Bloomberg has learned that commodities giant Glencore is getting closer to increasing its offer for tech resources. In a move aimed at ending the battle for the Canadian miner, Glencore is seeking to force Teck to the negotiating table with an improvement to its $23 billion bid. Teck patriarch Norman Keevill's super voting shares gave him a veto on any big decisions. Keevill has so far strongly opposed the deal. Now, Nvidia's market valuation fleetly crossed the $1 trillion threshold after the chipmaker's AI prospects vaulted it into an elite club of just 5 American companies. Alphabet, Amazon, Apple, and Microsoft are the only others to have trillion-dollar valuations. Fewer than 10 companies globally have ever achieved the distinction. And Microsoft's fight with the UK over its takeover of Activision Blizzard has received a boost after a judge said the US software giant's appeal can start earlier. The UK antitrust regulator, which has blocked the $69 billion deal, had wanted to delay the hearing until later this year. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Leanne, thank you so much. Now, Britain, famous for its rain, but now the UK risks becoming a cautionary tale of how developed countries can squander one of its most important resources. Now, a fifth of Britain's water supply is lost through leaks. And now the situation is actually being made worse by climate change. So let's find out more. Bloomberg's Olivia Rutgard is here with the very latest. Olivia, good morning. Thanks so much for coming on. You wrote a beautiful piece on this, important piece that we're also pushing out on social media. We have a water crisis in a country that's long been associated with soggy weather and an abundance of water. So how did we get here?
Yeah, so probably the first thing to say is that Britain is a bit less soggy than people might imagine. So
it doesn't feel like that.
I know, it doesn't, does it? But certainly in the southeast, London, where we are now, we get less rain than parts of the Middle East, parts of Africa. People might be really surprised to know that. So there's an existing issue there. And then in terms of the kind of ongoing issue, there are two ways you can think about it. There's the supply side, there's the demand side. So in terms of demand, people actually use more water in this country than they do in a lot of Europe. So it's about 150 litres a day, which is more than the European average of about 120.
Do you know why?
It's partly because I think people don't think about water as a scarce resource. Yeah. Exactly. So I think that's part of it. Yeah. I think probably some of it comes down to the weather. We do get cold winters, so maybe we're taking long hot showers in a way that, say if you live in Spain or somewhere like that, you might not. But I think leaks also come into it as well. So as you said in your intro, about a fifth is lost through leakage. So that has a big impact on the demand levels as well.
So Olivia, what does it take to actually fix this broken system?
So I think it's fair to say priorities have changed. Some of the water industry and regulators are sort of waking up to the issue a little bit more now. So there's a big program of investment coming through. We need more reservoirs. We need more water transfers from the west, which gets a bit more rain, over to the drier, more heavily populated east. And also, some of those water-saving methods at home, so soakaways, so that we can flush our toilets with grey water and things like that, better building regulations, building standards, and easier planning for things like reservoirs, which have been blocked. So there's a big program of investment coming through. Unfortunately, bill payers will pay for it. The industry is privatised, so it's going to come through to the consumer, which is not great timing.
Yeah, so I was going to say, how much is it the responsibility of private companies, and how much is it the government? Like, who do you blame for this?
Yeah, so I think ultimately the private companies they're sort of contracted out, and they're regulated by the government to provide the services. So the way it works is the water companies sort of have to apply to their regulator, Ofwat, to say, can we charge our customers this much? And then we plan to put this much money into investment. And I think what's been happening over the past few years is the signals have just been wrong. The signals coming from government and from the regulator have been, let's keep bills low, the status quo is fine, and there hasn't been enough making things fit for the future and thinking about that big future risk from climate change.
And Olivia, is this a real template for other countries? When you look at the UK and you think, I mean, maybe it's the wrong perception, but because the UK has plenty of water, also because it's an island, does it make other countries think twice about how they manage this gorgeous resource?
Yeah, I mean, I think Britain has been a little bit more, has thought about it a bit less closely than, say, somewhere like the Middle East. So if you look at something like desalination, there's a lot of that goes on in the Middle East. If you look at California, they're very aware of their water stress. So, I think in a way, like, Britain is kind of a victim of its weather patterns and the fact that it hasn't had this long history of water stress that other places have. So, it's probably a cautionary tale in that sense for maybe parts of Europe, because I do think that this is probably an undervalued issue in other parts of the world as well.
All right, Olivia, thank you so much for some great reporting. Olivia Woodgard there on water in the UK. Now, we'll be covering all things UK every week on Thursdays at 9:30 a.m. London time, also in our half-an-hour UK special. Coming up, we take a look at European inflation figures with CPI readings from France and German states. Also, Italy's due shortly. That's next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, big day for European inflation data. We've had France and several German states give CPI readings this morning. Italy also reports their CPI data in about 10 minutes as the country's central bank governor delivers a speech today. Well, joining us now is Bloomberg's Oliver Crook in Berlin, Chiara Albanese in Rome. So let's start with you. Ollie, when you look at some of the important inflation data, they're all pointing to the same thing, is that there's actually a slowdown in inflation overall.
Correct, and that's what we've seen this morning out of many of the German states, namely North Rhine-Westphalia, which is the biggest state in Germany. It's about the size of the Swiss economy, so we're going to take a look at that, breaking it down a little bit to see kind of where the inflation came through. So the good, the bad, and the ugly. Well, let's start with the ugly first. Food and beverages still up 15%. That is down from 17%, however. So that is, we can call that improvement. But however, you look at alcohol, tobacco, you look at leisure costs. All this stuff is still being supported. So the services side of the economy, people are still spending money, still elevated at around 10%. However, for the good, you go to the energy sector, up only 0.8%, which is great. And then down from the transportation side, it actually is the only category that year on year has gone down. And that is because the German state has rolled out this month the 49 euro ticket, which has sort of has a disinflationary impact, which is a subsidy to all train travel. However, starting next month, you'll get the base effect from last year's 9 euro ticket, which was a massive subsidy. So you're going to see that bringing the inflation right back up in June.
So, Ollie, when you look at recessionary prospects for Germany, how's the job market holding up?
Yeah, so we've had some pretty bad data in a lot of the German economy. We've had PMI that's been in contraction since July of last year on manufacturing side. Industrial production is not great. GDP, as we know, last week we went into recession. However, the job market has held up. We just got jobless claims today that were stronger than we had anticipated, only 9,000. The unemployment rate has stayed at about 5.6%. So really the question is, will we be able to get a substantial kind of reduction in inflation while this labor market is still holding up? IFO, however, out with a survey yesterday saying that real estate firms and housing firms are considering job cuts. So they may not be coming in, but they're thinking about it. And they're also saying that in the services sector, which has upheld a lot of the economies throughout Europe, we're seeing that there is confidence diminishing there. So perhaps the labor market softening in there as well.
Ollie, thanks so much. Oliver Crook there in Berlin for us. Chiara is our Italian politics expert. So, Chiara Albanese, when you look at the inflation prospect in Italy, how different is it from other European countries?
Well, thanks, Francine. Clearly, inflation in Italy continues to be an issue, but at the same time, the economy is also doing quite well. We had the economic data today, which came through slightly better than expected, and that continues to be favorable to the government and to Giorgia Meloni. Again, today, the Bank of Italy governor, Ignazio Visco, he's outgoing out of his mandate. He's delivering his final annual speech, and clearly having a strong economy, even in spite of a quite high inflation, allows for some leeway in terms of the policies that are going to be taken, and also investors' confidence that the government continues to more or less keep the big mammoth debt that Italy has under control.
So, Chiara, first of all, who's likely to replace Ignazio Visco? And is this really going to be the most important appointment for Giorgia Meloni?
Well, Giorgia Meloni clearly has all eyes on her in making this choice. She still has a few months before she will decide. So a few names have been touted, but we're nearly not close enough to really have a short list of names. But the political debate is going to be furious around that topic. Now, that will be a defining appointment that Meloni will have to make, and she will definitely have to make sure that she's able to control the pressure from political parties and stakeholders in the choice.
All right, Chiara, thank you so much. Chiara Albanese there in Rome, of course, one of our star politics reporters. Now, let's also take a look at some of the things that the markets are watching out for today. As we've been discussing, we have a host of inflation data from across Europe, including a provisional reading of Italian CPI for May. That's at 10 a.m. UK time. At 1 p.m., we'll get a provisional reading for Germany CPI. 3 p.m., it's U.S. jobs, job opening releasing for April. And then at 7 p.m. UK time, the Fed publishes its latest beige book giving insight into economic conditions across the U.S. Well, Bloomberg Surveillance Early Edition continues in the next hour with Kriti Gupta in New York, Anna Edwards here in London, and this is Bloomberg.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. One step closer. The U.S. House plans to vote today on the debt ceiling bill after clearing a key procedural hurdle with just days remaining to avoid a default. China's economic recovery weakened in May, raising fresh fears about the growth outlook. Calls are rising for more central bank action to counter the downturn. Plus, an exclusive with Jamie Dimon. JP Morgan CEO talks China, the debt deal, and his long-term future beyond leading the banking giants. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. And Kriti, it seems that the weaker sentiment coming out of the Chinese data print weighing on investor thinking this morning here in Europe.
Yeah, now that you have the debt ceiling potentially out of the way way. Look, it's not a done deal just yet, but potentially out of the way. It feels like the market isn't necessarily diving into that relief rally that a lot of people expected for the exact reason, Anna, that you mentioned. Some of that sentiment that you're seeing in Europe perhaps folding over into the United States as well. We're not looking at S&P futures this morning. We're looking at NASDAQ futures, which I should say are rising at about the same margin as S&P futures. And that is important because breadth is an issue in this market. Futures, NASDAQ futures lower by about 0.2%. Well, again, it comes down to breadth because a little fun fact from our markets extraordinaire producer, Dan Curtis, Anna, get this, we are at the worst breadth when it comes to market gains for the S&P 500 on the month, going all the way back to 1989, which really speaks to that tech leadership. And that's why the NASDAQ futures contracts are, I would argue, a little bit more important than S&P futures simply because of that tech outperformance we've seen in the last few days and weeks. Blame AI, blame the defensive positioning. We'll dive into all that. But what you need to know is they are down about 0.2% as well. The 10-year yield down as well, only by 2 basis points, though. The bond market catching a little bit of a bid. So you are, again, seeing that defensive positioning show up in the bond market, again, based on those growth worries. And a similar trade is showing up in the dollar as well, stronger by about 0.4% on the Bloomberg dollar index. Again, if you're concerned about recession around the corner, Anna, you're going to see that show up in commodities. And NYMEX crude, again, trading below a 70 handle, 69.06 on that contract, down about 0.6%. But to your point, it really does all kind of come back to the Asian story. And that's really where this kind of low risk sentiment really kicked off overnight. You saw that not only in the Chinese markets, but in the Japanese markets as well. The Nikkei down about 1.4% overnight. The Hang Seng really taking a tumble down, just shy of 2% there. Remember, the Chinese stock markets have been on that cusp for a bear market for a while, really keeping an eye on that. But again, it's showing up in the currency market as well. This is a cross-asset global story, Anna. Dollar yuan, you are seeing the weakest levels on the offshore yuan that you have seen in about 12 months. So you're seeing 7.12 on that exchange rate. And again, some weakness in the Japanese yen as well, down about 0.1%. Interesting, Anna, to see Japan, China, and now U.S. futures all on the same page this morning.
Yeah, absolutely. And here in Europe, we've got negativity to report as well, Kriti. So this is the risk-off picture for European stocks. Off earlier lows, though, if I can add that slight element of positivity into the mix. But we're down by 0.1% or so in London, 2 or 0.3% to the downside over in Germany and in France. And we have weakness then across European equities. We are seeing selling of stocks and buying of bonds, buying of the dollar, those big themes dominating trade today. But not too much selling now on equities. I put in euro and the German 5-year yield as we've got some interesting rethinking going on around the inflation story in Europe and what that means the ECB will have to do. We're seeing traders pull back their expectations for just how much hiking we'll get from the ECB, and all of this on the back of data that's come out from various parts of Europe that has been better than expected. So that's lower than anticipated in terms of the inflation prints. That was the case in all of the German regions we've heard from. It was the case in France. It was the case yesterday in Spain. It was not the case in Italy, though. The Italian inflation rate just coming in at the top of this hour fell to 8.1% in May. The estimate was for a drop to 7.5%. So moving in the right direction, not as much as had been expected, though. Germany's Saxony, that regional number, though, keeping with the trend. Prices month on month falling by 0.3%, and the prices year on year rising by 6.5%. So once again, we're seeing there this trend of inflation prints coming in lower than had been expected. So that means the ECB maybe doesn't have to hike so much. Here's SBB. That's what we call it when we certainly can't attempt. Our Swedish is not quite up to managing to pronounce the entire name of this real estate business over in Sweden, at the heart of the real estate issues that we're seeing there. And we've seen a parent business of this company, or a parent business of this company, has managed to miss one of its debt payments. It's not a default. This is a hybrid instrument, so this is flexibility they are able to have, but it didn't mean good things for the stock. And Brent crude down by 0.6% this morning on the back of a decent drop yesterday, 4% weaker on WTI in yesterday's session, Kriti.
Certainly something we're keeping an eye on. I admire you for sticking with the SBB. I wouldn't even want to admit that I couldn't pronounce or even try to pronounce the Swedish real estate company. We thank you, as always, Anna, for that update. Let's talk a little bit about the macro story when it comes back to stateside, because, look, we're not over the hurdle yet, but we're almost there. The debt limit deal struck by President Biden and Speaker Kevin McCarthy is heading toward a vote today in the House. In a Bloomberg exclusive interview, JP Morgan CEO Jamie Dimon says he's hopeful it will pass.
So I wish one day we get rid of the whole debt ceiling thing, but I understand when, it's a democracy, people have different opinions about what we should be doing, and it's just one tool for one party to, get the other party to the table. So I'm quite optimistic there, and I really do applaud the fact that they all sat down and spoke, got something done.
Joining us now, Bloomberg senior editor Bill Ferries, who formerly covered Washington for years. Bill, how confident are we that this is a done deal? For our international audience, talk to us a little bit about the developments from last night.
Well, everything's certainly headed in the right direction. I mean, you have the Speaker of the House, Republican Kevin McCarthy, and the top Democrat in the House, Hakeem Jeffries, basically scheduling the vote potentially as early as Wednesday evening. You know, that signals confidence that they're going to get it through, even as they acknowledge that they're going to lose people who are essentially to the left of President Biden and to the right of Speaker McCarthy. They just don't believe that that will be a critical mass able to stop passage. Then it goes to the Senate, and there each individual senator has a lot more influence over whether this passes or not. Everything looks like it will pass, but I think this could still very well go to the last minute. I mean, we're talking about a Monday deadline for the U.S. to hit the debt ceiling. It wouldn't surprise me if this bleeds into the weekend, if this perhaps final legislation goes to President Biden's desk on Sunday. But everything points to this heading towards the conclusion I think markets and most lawmakers would like to see.
Yeah, with cameras trained on Washington, then, Bill, there's still time for some lawmakers to want to make a noise, isn't there? In terms of what happens from here, is Speaker McCarthy's job now at risk, given the frustration that we've seen among some Conservative members of his party?
Yeah, there's definitely members on the right who are really frustrated at how this agreement was reached and what the terms are on some of the really difficult issues. You know, Kevin McCarthy, it took 15 rounds of voting for him to become Speaker. But during those 15 rounds, there was really no other viable candidate. So the problem Republicans who are opposed to McCarthy have is that they would have to replace him with someone. There is no candidate for that job right now. So I think for right now, unless he makes other decisions in the coming months or over the next year or so that really frustrate a bigger group of conservatives, I think his job is likely safe for now.
Bloomberg's Bill Ferries keeping us up to date on the minute-by-minute developments of this debt deal. Again, we are almost there, but not quite. We thank you as always. And of course, in the absence of that finiteness, for lack of a better term, you are starting to see the market really pivot to the other major story, which is China. China's manufacturing activity contracted for a second straight month in May. It's more evidence that the post-COVID recovery has slowed in the world's second largest economy. For more, let's bring in Bloomberg economist David Chu. David, what's your reading on the latest data set here? Just how much trouble is not just China, but the global economy in right now?
Yeah, I think so. The data today showed us that the recovery is losing some steam, especially in the manufacturing side, as we have seen the manufacturing PMI in the contraction territory for 2 consecutive months. And that means that because the manufacturing sector has been the major engine for China's economy during the past 3 years in the pandemic period. But now it seems that it's losing steam. On the other hand, we have seen the servicing sector related to travel and the catering, you know, and all the sectors related to the reopened economy are still strong. But at the same time, the housing sector is sending some worsening signals, especially with the indicators, the sub-indicators in this sector is still in the contraction range.
Okay.
That tells us that the recovery is not balanced. So we still have a lot to do.
Okay, yes, so an important data set then being released today on China. David, JP Morgan CEO Jamie Dimon spoke exclusively to Bloomberg earlier at the bank's Global China Summit in Shanghai. Let's just have a listen to what he had to say about the China-US relationship.
Over time, yeah, there'll be less trade. You know, it'll take years for these things to take place, but it won't be a decoupling. And the world will go on.
So not a decoupling, he says. The focus, of course, is on de-risking. That's the language that's being used now by the US administration time and time again. What do you think the Chinese government wants to do on this particular front then?
Yeah, definitely China benefited a lot from the globalization and the increase in global trade. So that definitely China wants to keep the door open for global trading. But on the other hand, geopolitical things have become more and more tight than before. So I think it is a more realistic way for China to seek more support from the domestic market for the growth in the future. So I think China is the government is already doing something to boost the domestic consumption. But to be honest, it won't be easy because if you look at China's GDP, the domestic household consumption takes merely below 30% of the GDP, and the government side and the investment side takes more than 60%. So that it means that there must be some structural reason that weighing on the consumption. So it means that the government has a lot of things to do to release the power of the consumption.
David, thanks very much. David Chu, Bloomberg economist there in Hong Kong for us. And now let's pivot from the Chinese economic story to some macro data out from Europe today. It's a big day for European inflation data. France slowing more than expected on the inflation front. Italian inflation coming out higher than expected. Several German states give CPI readings this morning, and we've got most of those, and they've all come in slower in terms of inflation than had been expected. And we get the national reading later on today. Let's get now to Bloomberg's Maria Tadeo in Brussels. Maria, take us through some of the data here, because if we look at Spain yesterday, France and Germany, we get quite a clear picture.
Yes, and it may be pointing to a cooler summer of all things. When you look at the data that came out today from the French economy, you see again this deceleration in prices. The finance minister, by the way, telling the French radio that prices are in fact coming down fast. The central banker also suggesting perhaps inflation now past peak in the French Republic. When you look at the Spanish numbers that came out yesterday, a lot of people focus on Spain as a forward-looking indicator, also significantly cooler for May. Germany, again, we don't have the full number, as you said at the start of the show, but the numbers that we see so far may point again to cooler inflation too in the biggest economy in the euro area. Italy, a little bit of an outlier as it is at times. Growth was better than expected. Inflation did cool, but not by as much as expected by economists. A lot of this, Anna, now provides a picture, or could provide a picture for the big euro area number that we're expecting tomorrow on Thursday. Now, if you put them all together, you could believe or suggest that, again, this cooler inflation will be reflected on the overall number, and tomorrow there could be some relief for the ECB if indeed that manifests in the broader euro area number.
Maria, what does that mean for the ECB, especially in light of the potential changing of the guard we might get over at the Bank of Italy? Put this into context for us.
Yes, and look, whether or not there's a new governor in the Bank of Italy, I doubt very much that it will change the impressions that we hear from Visco, who is the governor of Bank Italia at the moment, who has said, yes, of course, we need to hike rates. Inflation is an issue, but also not be too abrupt to strangle the economy. Now, beyond that, when you look at the European Central Bank, we know that they will continue to hike rates. They have said that clearly. When you listen to the words of Madame Lagarde, you know there's more to come, but it's also clear that they have entered the final stage. The question is by how much. When you see the numbers today, you see that reaction from the market already pared back that cumulative 50 basis points bet, and of course there is a decision expected in 2 weeks' time from the ECB, the June meeting. I cannot believe we're in June, by the way, already this fast, but of course the focus will be on the downshift to 25 basis points already done. What comes next?
Okay, not quite. The 31st of May, I think, Maria, but almost in June. Your point is well made.
Every day
Where did
counts.
that time go?
Every day counts.
Every day counts. I'm not saying goodbye to May that easily. Maria Tadeo, thank you very much for the latest on the inflation prints out of Europe there in Brussels. Now, coming up, we will speak to the economist Sarah Kewen of Standard Chartered and FX strategist Jane Foley of Rabobank. Lots to talk about the Chinese growth engine, about the inflation prints coming through in Europe. Lots to discuss, plus more from our exclusive interview with Jamie Dimon as he hints at life after JP Morgan.
I love my country, and maybe one day I'll serve my country in one capacity or another, but I love what I do. I think JP Morgan do a great job for helping Americans, for helping countries around the world, and this is my job.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Look, one of the big questions here is now that kind of this easy monetary policy era is in the rearview mirror, what does that mean for the credit markets? You have a little bit of tightening there, but yet you've had a lot of folks perhaps come to market, not just here in the States, but in Europe as well. For our radio audience, bear with me. We're looking at a chart here, a bar chart of total May issuance in billions of euros for the European bond market. Now, we've seen issuance really boom, the highest amount of deals going all the way back to 2020 when we did have that easy monetary value. I wonder what that means. Is that a signal that a lot of corporates, a lot of kind of funds are perhaps making that dash for cash before things get even tighter? Or is there something else to it? Let's bring in a true expert here. Donna Baltaji, one of our markets editors, joins us with some clear context. Donna, what are we looking at here? What does this really mean?
So we're looking at two things. One, we're seeing issuers that are finally come to terms with the fact that you've got to sell when the market is ready for you to sell. So you can't wait for better pricing. What you really have to wait for is for that cash to be ready to be deployed by investors. And from the investors' point of view, what we're basically seeing is that they are understanding that with the risk of recession on its way, that these very high rates might not last forever. So if you can lock in those rates now, you're probably set for a few years.
So that's interesting. That's driving things on the investor perspective. Dana, good morning to you. But in terms of these corporates, you say that they've learned they've got to sell when they can, sell their debt when they can. But there's also perhaps a window here before we see a lot more T-bill issuance. Is that something that's going through these treasurers' minds when they think about when they raise money?
Oh, absolutely. I mean, we're basically expecting a flood of these T-bills, and what that will basically do is that will raise borrowing costs, not just in the U.S., but around the world. And when you have that, plus central banks that are also raising rates, the hit on borrowing costs can be significant. So for that reason, it's a good deal for the issuers, but it's also a good deal for the investors themselves. Bear in mind, though, the summer is on its way, and in the summer, everything slows down. So you got to sell when you can.
Okay, Dana, thank you very much. Dana Elbataji joining us there with the latest on credit markets. And for more market analysis, check out MLIV Go on your Bloomberg terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. North Korea has confirmed that an effort to launch a military spy satellite into orbit failed earlier today. The official news agency reported a rocket crashed into the Yellow Sea after losing propulsion in the second stage of the ascent. The launch initially prompted missile alerts in both Japan and South Korea. Pyongyang says it will attempt another launch soon. Elon Musk has told China's foreign minister in Beijing that the interests of China and the U.S. are intertwined, echoing recent remarks from the bosses over at Apple and Mercedes-Benz. The Tesla chief met Qin Gang on his first post-COVID visit to China. Musk is expected to tour Tesla's Shanghai factory later today. Theranos founder Elizabeth Holmes has reported to prison to start her 11-year sentence for defrauding investors over the company's unreliable blood testing technology. A federal court convicted Holmes of wire fraud and conspiracy last year, with her final appeal failing last month. The 39-year-old is being held in a minimum security prison near Houston. Goldman Sachs is said to be considering another round of job cuts as the deal-making business remains slow. Sources say the third round of cuts will affect less than 250 people and will include the firm's more senior employees. Earlier this year, it had eliminated about 3,200 positions, embarking on one of its biggest rounds of job cuts ever. Anna, things are really heating up in terms of the cost efficiency story now on Wall Street. It felt like those rounds of job cuts that you saw among perhaps junior bankers, even mid-level managers, wasn't necessarily going to seep up to the higher levels. But Goldman Sachs, Lazard, even First Republic, although that was a more micro story, really feeling the pains across all ranks.
Yeah, absolutely. We've been seeing this within investment banking for some time, haven't we? From other banks and also from Goldman Sachs. And we heard at the beginning of the year a big round of cuts over at Goldman Sachs. This time, to your point, Kriti, things are going higher up the food chain. More senior, it seems, are the people who are going to be going this time, but fewer in number. So not the sort of thousands this time around, maybe 250 or so people. But of course, we'll continue to monitor these stories carefully for you. Coming up, we'll get back to the macro themes, though. Sarah Hewitt, head of research for Europe and Americas at Standard Chartered, joins us. What is her thinking? What is her team's thinking around where the Fed heads next? What is in the driving seat? Is it the Fed? Is it the debt narrative still? We'll also talk about some of the data coming out of Europe today. Really interesting the way that the inflation prints have almost consistently come in below expectations. What does that mean for the ECB? This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. One step closer, the U.S. House plans to vote today on the debt ceiling bill after clearing a key procedural hurdle with just days remaining to avoid a default. China's economic recovery weakened in May, raising fresh fears about the growth outlook. Calls are rising for more central bank action to counter the downturn. Plus, an exclusive with Jamie Dimon, JP Morgan CEO, talks China, the debt deal, and his long-term future beyond leading the banking giant. I'm Kriti Gupta in New York with Anna Edwards in London. Anna, a lot to digest here, but it very quickly feels like the narrative shifted from debt ceiling panic now to Chinese growth panic. What are you seeing in Europe?
Yeah, absolutely. We got the data from May, didn't we, for the Chinese economy, and that gives us substantial insight into the second quarter in China, the world's second largest economy, and things not looking as rosy as had been expected there. Certainly on the manufacturing side, although that is a bit of a global story, but certainly on the manufacturing side, that disappointed in China, and that weighs on sentiment here in Europe. We're off earlier lows, if I can add that little area of brightness, but still we're down by 0.2% on the Stocks Europe 600. Here in Europe, then, Kriti, we've had some really interesting inflation data coming out from Spain yesterday, to France today, to the German regional data. We get the national data from Germany later on. All of that adding up to a reassessment of just how much hiking we're going to get from the ECB, because all of the data suggested some work has already been done in bringing down inflation rates. Italy was a little bit different, but leaving Italy aside, we see that reassessment taking place, and the euro down at 106.70, down 0.6%, and we see those bond yields are falling 8 basis points or so on that 5-year bund, but certainly that is the direction of travel that we have here. Brent crude is interesting as well, thinking of deflationary forces. This is being weighed on by that sentiment out of China, then, Kriti, down by 0.8% on the oil price, and that follows a big 4% retreat in WTI yesterday. A lot of concern about demand for these commodities.
Yeah, it's going to be, I think, a rising concern, Anna, as we talk again about those recessionary concerns. How quickly does that inflation story that we are still battling, by the way, on the monetary front turn into the R word? And I think a lot of that concern is coming out of Asia. To your point, Anna, something that's, to your point, again, driving the European story. Well, sentiment is kind of seeping into the NASDAQ futures as well, which is interesting because buying big tech has been the trade du jour over the last, I want to say, 7 to 10 days or so. NASDAQ futures right now, though, taking a little bit of a breather, down 0.2%. And I should say, even on the micro front, you're seeing that in, for example, NVIDIA shares, even in the pre-market, taking a little bit of a breather alongside all of the names that have really been catching a big bid in the last 10 days. The 10-year yield also dropping a little bit to the tune of about 3 to 4 basis points. Look, it's important to note that the bond market is catching a bid, despite the fact that the debt ceiling deal isn't 100% through. So really keep an eye on that kind of relationship between the stock market and the bond market, or I should say the lack thereof, Anna. The bond market, though, if you're seeing a defensive play there, is showing up in the FX market as well. The Bloomberg Dollar Index stronger by 0.3%. The positioning is going to be crucial here. We're going to talk about that with Jane Foley in just a few minutes. And of course, NYMEX crude, to your point about the commodities trade, we're coming full circle. 68 handle on that contract, Anna.
Yeah, 72 handle on Brent. Let's think about where we go on the global growth story. Sarah Hewitt joins us, head of research for Europe and the Americas at Standard Chartered. And let's start then, Sarah, with the data we had out of China and what that has done to add to your understanding about the weakness in growth, in particular in manufacturing, and crucially, what can be done about it, or who you would look to try to do something about it.
Yes, it's very clear. Particularly the heavy industry manufacturing is doing worse than expected. The PMI data came in below expectations. On the non-manufacturing side, I think we saw some positive signs, particularly for hospitality. So consumption for services seems to be holding up pretty well. Perhaps a little bit more optimism on the construction front as well. But clearly, manufacturing is soft, and the export outlook as well seems pretty bleak. Overall, it's not a great picture, although we are seeing, as I say, some recovery in consumer spending on services, albeit potentially at the expense of spending on goods. What happens to policy from here? We're still somewhat cautious about expecting further policy easing. There is already a fiscal stimulus in place. I think that Beijing is anticipating that there will be more momentum going forward, but they will be watching very closely what's happening to consumer sentiment, which remains very sluggish in the face of still high unemployment, particularly amongst younger people in China.
Sarah, connect the dots here for us, because I think it's been a couple of years now where we've really seen the monetary policy story shift between, say, the PBOC and the Federal Reserve, and arguably the ECB somewhere in between there. That shift that you start to see between the two major economies in the world, or the two largest, I should say, do you start to see them kind of coming back together, the PBOC and the Federal Reserve perhaps joining together to become on a more stimulative page?
Well, certainly for the Fed, our view is that we're at the peak in rates in this cycle, and that the next move will be for rates to come lower, potentially later this year. So I think it's perhaps too early to talk about stimulus from the Fed just yet. We are still getting some pretty punchy inflation numbers. The jobs market is still very strong in the US, and that needs to shift before the Fed will be comfortable with, confirming that they're on hold, let alone before they start to cut rates. But we do think that we'll have a slowdown in the economy later this year, unemployment starting to rise in a meaningful way, and despite the latest core PCE deflator coming in above expectations, we think that inflation pressures broadly are on a downturn. We're watching very closely what's going to happen to average hourly earnings this Friday with the employment report. They obviously sort of picked up more than expected in April, but if we get a return to what we saw in the first quarter, then that sort of earnings growth is consistent with inflation moving back to target. So it does open the door, in our view, for the Fed to start to cut rates around the turn of the year, in which case you'd see accommodative policy from China, policy staying restrictive in the US, but moving towards a more accommodative stance over the course of the next couple of years.
And Sarah, so that's on the monetary side. Let's talk about the fiscal side specifically. We've kind of gone over a little bit of the details of the debt ceiling here, and essentially the cap on fiscal spending for the next 2 years, although I should mention defense spending is actually going to increase. Sarah, over the next 2 to 3 years per se, what is the bigger factor here? The debt agreement or the fiscal budget in the U.S., or perhaps the geopolitics and the domestic spending from the Biden administrations? What factors as a bigger role into U.S. GDP?
Quite honestly, all of the above. But if we take them each in turn, then agreeing the debt ceiling and agreeing that will be sustained through the next year or so and beyond the next election is going to be positive in terms of sentiment. We did have some hints that consumer sentiment had suffered as a result of the uncertainty over the debt ceiling. So an agreement, assuming that does go through Congress today and by the weekend, then that's positive for sentiment. There is a fiscal squeeze in place. Consumer spending, government spending, discretionary spending is going to drop back to 2022 levels. Now, bear in mind, of course, that as a share of GDP, that will still leave government spending higher than it was in 2019. We have had a big run-up in government spending through the pandemic, so not all of that is going to be going away. We may see later this year some further headwinds as a result of the agreement on restraining spending, and that may well coincide with a period when we have softer economic activity generally. Over the next couple of years, then I think that some geopolitics will probably be in focus.
And Sarah, a word on the ECB. Has your thinking been informed, shifted at all as a result of the inflation prints we've had over the last couple of days from Spain, from France, from the various German regions, all coming in below estimate?
Yes, it's moving in the right direction. To an extent, seems to be down to food inflation moderating. It's still high, but moderating more than expected. We'd be cautious about reading too much into 1 month's figures, of course. Our own view on the ECB, though, is that we don't think they're going to be raising rates as much as markets expect from this point. There was a clear signal from Lagarde that they still have more to do, but we think that by the summer we will be getting further indications of moderating inflation. The real uncertainty is what's happening to wages, and we know that that's where policymakers, both in the US and in Europe, are concerned that we enter a wage price spiral. Maybe there's more concern still on that in Europe than there is in the US, which is why we think the ECB still has more work to do, whereas we think the Fed has probably done enough.
OK, more hiking still to come then. Thank you very much, Sarah. Standard Chartered's Sarah Hewitt joining us there with the latest on various economies around the world. Coming up next, we'll talk to Jane Foley, Head of FX Strategy at Rabobank. We'll get a perspective on currencies next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Look, we're talking about growth all of a sudden, and the best way to look at where people are really thinking about this is in the FX market. There's really no place to hide in this particular asset class, which brings me to a positioning story I want to bring to your attention. Anna, we are looking at specifically just this bet into the dollar. Now, this kind of made sense as we were talking about the debt ceiling debate, the idea that in this kind of potential global catastrophic doom and gloom scenario of the U.S. defaulting, why not buy America as kind of this defensive trade, the irony, the paradox of that. Nevertheless, you are starting to see a lot of folks really be long dollar when you look at speculative positioning. But the question is, in a decelerating growth environment, is that still the trade? Let's get a little bit of expertise here. Joining us now is Jane Foley, Head of FX Strategy over at Rabobank. Jane, talk to us about this dollar positioning. If we're worried about Chinese growth momentum kind of declining and that really accelerating the recession that we've expected to be around the corner for the last few months, arguably years, is this dollar trade something that makes sense?
Oh, absolutely. In fact, there's pretty good inverted relationship between the dollar and high risk assets, so emerging markets equities, for instance. And the reason being is that, if you really want to buy risk, well, you generally sell the dollar and vice versa. And of course, right now, we're facing quite a lot of headwinds. First of all, the Chinese growth story, clearly that's been a major disappointment this year. At the start of the year, there was so much optimism about the outlook for China, that rebound story from the COVID lockdowns. That is disappointing. On top of that, there's the risk of US recession. And of course, for the Eurozone, well, there's a likelihood that they're facing stagnation in the second half of this year. So you've got a pretty disappointing outlook for growth, not an environment where you really want to be piling in en masse and into high risk assets. And therefore, the dollar is likely to do well in this sort of environment.
So a lot of headwinds, Jane. I'll pick up on the European one there. Stagnation in the second half of the year, you say, perhaps. We've seen, of course, recession in Germany, other parts of Europe perhaps managing to avoid that fate just yet. What are you expecting to see in terms of the euro then and how it trades through that?
Well, the euro is approaching all of these headwinds with the market position really quite long. And, the euro had a really good run, say, from around October last year, right up until a month or so ago. And this was built around, the hawkish story from the ECB, which now is come to an end. We're seeing the market pricing out some of those last bit of tightening. But also the Chinese story plays into the European recovery story, or it did, because, China is Germany's largest export partner. And we've heard, China or Chinese consumer, they're buying less goods, a little bit more in services, but less goods. They buy a lot of German cars, a lot of German machinery, etc. So that feeds back into disappointing Eurozone story. And certainly last week, if we looked at those PMI data, the new orders for the manufacturing sector in Germany, they were really very disappointing. So we've got the market positioned long on the euro. And what have we got now? Well, the ECB, we're seeing weaker than expected CPI data, and the scenario where Germany did have a technical recession over the winter, and we've got stagnation. So I think for the euro, the market's probably reevaluating why it's holding those long euro positions right now.
Right, so the long euro position then in contrast to the news flow. So Jane, how many hikes do we get from the ECB from here?
Well, our official view is still that we will get to. I mean, okay, we've seen some good data insofar as it is coming off the boil in terms of inflation in the Eurozone, but it is only 1 month. And we've got to keep an eye on the core numbers too. And some commentators are expecting that core could remain sticky over the summer. Remember, in parts of Europe, that will be the tourism season. So we've got to keep an eye on it. But I think most people would agree is that we are coming towards the end of that cycle. And it is very unlikely that the market's going to start pricing in more ECB interest rate hikes. In fact, if you look back over the last few weeks, there's been plenty of hawkish commentary from the ECB in that period, but the market or the euro wasn't reacting to it. I think everyone is sort of understanding we're coming to the last part, to the last leg, if you like, of that tightening cycle for Europe.
Well, Jane, we've talked about the dollar, we've talked about the euro. To continue our kind of journey around the world, let's talk about the Asian currency specifically. We're seeing notable weakness in the offshore yuan this morning and the Japanese yen. Is this something, as geopolitics kind of re-enters the conversation and the macro trade, something that clients are asking about as kind of this weakness in Asian FX, perhaps incentivizing trade a little bit? How do you think about something like that?
I think these are very two distinct stories. I think for China, it is the weakness of the economy, the disappointment, if you like, from this bounce that we're seeing. And what's really happening as we see the disappointing growth data, the market's beginning to focus more on the flaws of the Chinese economy. The fact that households are highly indebted, the fact that the regions or the local governments are highly indebted, the fact that they've got a bad demographic, as we do, of course, in Europe as well. So the market's focusing more on the flaws. It's getting very disappointing, disillusioned, if you like, about the pro-Chinese story that a lot of people were more excited about again at the start of the year. So the risk that they could have more loosening in policy as the market's thinking about potential for more tightening from the US over the summer is really what's weighing on the renminbi. But for Japan, it's something different. We did have yesterday that emergency three-party meeting between the Japanese authorities, and that put the risk again, or the talk of, are they ready to intervene? Are they just putting a shot across the bows with respect to intervention? That's there. And at the same time, the market is thinking, is July on the table with respect to a change of yield curve control? So there's different aspects, if you like, going on in Japan than there are in China.
Jane, thanks so much. Thanks for joining us from Rabobank. Jane Foley with her views on the FX markets. Coming up, we'll get back to our interview with Jamie Dimon. He expresses optimism on the US debt deal. We'll bring you more from our exclusive conversation with the JP Morgan CEO next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. Now, with just days to avoid a US debt default, the debt limits agreement is headed to the House for a full vote today. JP Morgan CEO Jamie Dimon spoke exclusively with Bloomberg's Stephen Engel about the deal.
America, the financial system of America, and the economy of America, it's still the most prosperous and largest economy the world's ever seen, the most innovative, the most growing, and the rest of the world relies on it. So I think we shouldn't create any instability there. So I wish one day we'd get rid of the whole debt ceiling thing, but I understand when, it's a democracy. People have different opinions about what we should be doing, and it's just one tool for one party to, get the other party to the table. So I'm quite optimistic there, and I really do applaud the fact that they all sat down, spoke, got something done.
What's your read on inflation, on whether the Fed will go beyond the pause and hike again?
My simple view is that, they're right to pause at this point. It's been a big increase, 500 basis points or so. Take a pause. But I do think it's possible they're going to have to raise a little bit more. That, inflation is kind of stickier. I think people are coming around to that, which means rates may have to go up a little more. People should be a little prepared for that. Just as a matter of managing your own business, be a little prepared for that. Whether you're a financial company or a real estate company, et cetera. I think the other thing I'd be a little prepared for is the volatility that might very well be created by quantitative tightening. We've never really had quantitative easing, which we've had now for the better part of 15 years. And now you're going to see quantitative tightening. And I think the effects may be a little harsher than people expect. But hopefully we'll get through all of that and I'll be okay.
That was our exclusive interview with JP Morgan Chairman and CEO Jamie Dimon. A wide-ranging conversation. He talked about the debt ceiling. He also talked about his future. Worth looking up the rest of that conversation on the Bloomberg terminal. Now let's get a look at some of the things that are ahead for us today in the calendar. We will be getting the national report for German inflation at 8 a.m. Eastern Time. Key U.S. data due today includes Chicago PMI and JOLTS data, job openings, of course, out of the U.S. And that, of course, comes ahead of the jobs report, which is due on Friday. We're going to be speaking to a host of Fed speakers, or hearing from them throughout the day, with Collins, Bowman, Harker and Jefferson all on deck. So lots of Fed speak. And all of that is leading up to the Beige Book. That'll be released at 2 p.m. Eastern Time. Kriti?
Yeah, and of course, as we look at the macro, we're going to keep an eye on the micro as well. Some of the stocks we're watching in the pre-market already catching some of a bid, because even though on the macro front we do see a little bit of a pullback, a lot of that pullback is driven by the very stocks that took us to those highs in the first place. NVIDIA, AMD, of course, those high-flying chip maker stocks that have really caught a lot of attention in the last week or so off the AI bid, pulling back just a little bit. But look, NVIDIA shares still trading at about $3.95 a share, down about 1.3% for both NVIDIA and AMD, especially as AMD's Narode sells about $3 million of its shares. So really keep an eye on those insider moves. And of course, it all comes back to the AI story. And a C3 AI, we're going to call our small cap poster child. They are reporting results after the market close, but kind of in character, shares are up about 3% already in the pre-market. So we're going to talk to perhaps, or wait to hear from the CEO, perhaps in that earnings call, but whether this move is actually justified in the realm of AI. And speaking of earnings, HP Enterprise is one of the big movers we're watching, falling after their revenue disappointment. Remember, they are very exposed to that business investment, down about 8% in the pre-market, trading at about $14 a share. But again, all eyes on the earnings story for Salesforce, the ticker there, CRM, higher by about 1% already in the pre-market. So a little bit of optimism baked in those companies reporting after the bell today.
Yeah, absolutely. Lots of earnings stories then to look ahead to. And on the software side of things, spending has been a little depressed perhaps, but how much can they pivot the conversation to, you guessed it, AI? That seems to be the driver of expectations these days. So we'll see whether that happens at Salesforce, of course, under pressure from a number of activist investors there. That is it for Early Edition. Surveillance is up ahead. They'll be building, of course, towards some of those earnings stories that we just talked about. They'll also be talking about the debt ceiling and everything U.S. politics with Congressman Brian Steele, who'll be joining the team. That is a conversation coming up at 8 a.m. New York time. This is Bloomberg.